Hey, what's up? John Sonmez here from simpleprogrammer.com. So I got a financial question today that I thought I'd answer. This involves stock trading and options trading specifically. This is something I talked about in my soft skills book, so that's where the question is coming from. I'll go ahead and read you the question. It's a little bit long, but I think some of you will find this useful if you're considering doing some options trading or stock trading, even though I will say that that is not the preferred way to make a lot of money, honestly. Like, this is there's some really good books on this, which I'll recommend a little bit later on. Actually, I might as well just recommend them now. The first one is called The Millionaire Fast Lane by MJ DeMarco. He goes definitely in both of those books into why that just investing in your 401k and investing in the stock market is not the best move if you really want to actually retire anytime soon in your career and you want to actually have money that you can actually use and enjoy and use in your life. So, you know, you can take it how you will. I know some of you would rather just slowly wait till you're 65, and that's cool. It's fine. So that's why but you need to know those two options there. So I definitely recommend that you read. Everyone should read those books. Honestly, really should. They're good books. So, with that said, let's get into this here. So Ivan says, "Hi John, first of all, I would like to thank you for all the awesome work you do. I found out about your Simple Programmer when I bought your soft skills book a couple years ago." So soft skills book, again, let's just plug a lot of books today. You can check that out. You can get it on Amazon. Just go click the link and you can get soft skills. Okay. And he says here, I bought the book a couple years ago and it changed my life. Cool. My salary is now higher. I've started my blog and I started to market myself as a software developer. I've also become more interested in other topics such as economics, fitness, and investments. That's what I like to hear. Hence, I have a question about investments that may be interesting to your subscribers in the soft skills, In the soft skills book, you wrote about options trading and how this is superior to simply trading stocks. Since then, I read a bit about options trading and stock markets in general. I don't understand how a regular person that is not involved with the financial industry can trade options profitably. Let me describe you my thinking and hope you can help me find a flaw in it. When you buy an option, you essentially receive a right to buy or sell a particular stock for an agreed price. Correct? That's a pretty good summary. Therefore, to make option trading profitable, you need to not only predict the direction of a stock price change, but also its magnitude. Not quite true. And here is the catch. These options are sold by big financial institutions, and since trading is a lucrative endeavor, they don't take pricing them lightly. In fact, they do use a pricing model, but I won't get into that here. The Black-Scholes model. So they hire some of the smartest people in the world, brilliant mathematicians, software developers, former rocket scientists, top-notch traders, market specialists. All these people spend 12 plus hours a day analyzing markets, running simulations, building mathematical models, developing proprietary algorithms, all to trade fake shit. Isn't that funny? The vapor, but he's sort of right. This is true, at least in hedge funds. All to fine-tune options prices to maximize the company's profits. So if I understand it correctly, to beat financial institutions at their own game, you need to make better predictions than they do. For example, if they assume that Apple stock will increase in price by $5 in 6 months, but you estimate that it will increase by $10, then it would make sense to buy Apple call options. But to do this, you need to outsmart all these financial gurus since they select options prices. I think options trading can be profitable in just a few cases. This is long, but again, this is worth it, all right? 1, you're a seasoned trader mathematician who has a lot of time, skills, knowledge, and resources to build better models for option prices. I don't think that's going to happen. But these people either work in finances or used to work there at some point. But this is highly unlikely since I can't imagine an individual who has the resources that are on par with the smart money you can throw at market analysis. 2, you can buy options for some low-cap stocks that are below the radar of most financial institutions and maybe mispriced. Again, that's called an arbitrage situation. Not too many of those in an efficient market. 3, you have some not widely known or maybe even insider illegal information about a particular company and hence have an advantage. Let's see. So with all this, it seems to me that options trading either is a loser's game or can be profitable in some rare cases that may allow making some money here and there, but nothing more than that. In one of your videos, you mentioned you had some success with options trading. What do you think about my reasoning? Am I missing something? Sorry for the long email, but I think this is a complicated topic and I want to make my thinking as clear as possible. Best regards, Ivan. Okay, so here's the thing, Ivan. I'm trying to think where to start. The best way to start with this is to describe options trading. So what you're looking at is what I would call one-dimensional options trading, right? So one-dimensional options trading is no different really than stock trading except leverage. Okay, this is the same thing as trading futures, right? Or if you're trading futures, it's the same thing. It's just super leverage. So if you're just looking at options, okay, and just trading options by themselves, you're right. You need a crystal ball. You're just predicting things you're competing against. Like their models are going to be pretty good. I mean, you can make some money in options, but you're just going to be predicting something. And again, it's not like the options are perfectly priced, right? No one could see. This is the other thing: is like options are not perfectly priced, right? They're not priced. You just don't know if they're priced wrong or not. So it's still a crystal ball. It's still rolling the dice. It's still something where you're making a prediction. And anytime you're trying to make predictions about what the stock market is going to do, you're going to lose. And there are no experts. The experts do not fare any better than the average person. Right? I mean, there's some very rare cases of people beating the market, but if you look at hedge funds, right? There's what I think who had was it what's his name? Not why do I want to say Bernie Sanders? I don't think he had the guy that we always the Oracle of Wall Street, Berkshire Hathaway. I can't remember his name now. This is driving me nuts. Okay, you know who I'm talking about though, okay? For some reason it just slipped my mind. So anyway, he made some bets with hedge fund managers that no one could beat the S&P 500 and they didn't. It's ridiculous, right? So you can't, even you think these institutions know their shit and they're hiring rocket scientists, they're still, I'm not saying that there's no one making money and I'm not saying there's not any kind of super performing hedge funds, but in general, no one's predicting this. No one's beating the market. It's just too complicated. What they're doing is they're making money off of doing micro transactions, like seconds or not seconds, like hundreds of seconds of super fast micro trades, and they're making money in this very small arbitrage window. It's complicated, but you can look into hyper trading, and that I think there's some good books on that. I haven't read any books on it, but I studied it a while back. Anyway, if you're interested in all that, you can look that stuff up, and that's how a lot of these companies, a lot of these investment bankers and stuff make money, and really you're still not going to predict the market. So anyway, I don't want to sidetrack too much here. I just want to tell you that what you're considering is one-dimensional option trading, okay? Again, the only thing that it's giving you is leverage, right? And it's giving you the ability, and the reason why I say it's leverage is because if you buy a stock, let's say you buy a stock of Apple, okay? If the Apple price, let's say it's $100. I don't know what Apple stock is right now. I don't really follow the stock market anymore. Okay, so let's say it's $100 to make it simple, right? If it goes up $5, you now have $105. If it goes down $5, you now have $95, okay? That's just how it works. Now, if you bought an option on Apple, and you bought an option, you maybe for that same $100, you could buy an option to control 1,000 blocks of Apple stock, okay? But here's the rub. If it goes up, if it goes up $5, right, to 105, you're going to make $5 times 1,000. Sweet, $5,000, right? Okay, and you only paid 100, so that's going to give you $4,900 of profit. Pretty good, right? Did I do my math right? 5 times 1,000, 5,000. Yes. Okay. If it goes down $5, let's say I'm saying that you're buying a call option on it. Okay, not a put. Okay, but it works the other way too, right? So if it goes down then by $5, it doesn't even actually matter if it goes down at all, really. If it doesn't go above your strike price, whatever you're on your option, then you lose the whole $100. You lose it all. Okay, so it's just a leverage, right? It's just you're taking a bigger risk, right? And you could do the same thing if you had more capital. You could just buy 1,000 shares of Apple, right? But you're leveraging both the risk and the return. Okay, so that's what just an option does. And I mean, there's a little bit more to it in the fact that, you know, if you sold an option, right? This is buying an option. If you sold an option, which you can do as well, writing an option, then you sort of have. If nothing happens, you make money, okay? And if it goes down, you make money. If you sold a call op or put option, right? If you sold a put, and then, or if you wrote it, right? So in that case, only one direction hurts you, right? I mean, so there's ways you're using options. Are basically just, if you think of it as a financial instrument to be able to predict different things that are going to happen, right? So you can make money whether it goes up or down, or it doesn't move at all, it goes sideways, right? Or only if it goes up or sideways, right? But that's singular dimension options again. So if you wanted to make money, like seriously trade options, you would want to do what is called multi-dimensional options. So you would want to set up more complex options chains or option trading sequences, which would be things like one of the ones that I used to trade a lot was called an iron condor. And in that case, what you're doing is you're buying different options, and you're buying them that expire in different months. So you're going based on, I don't want to, I can't give a whole lecture on how complex option trading works, but it's basically you've got the time, right? And then you've also got the direction, okay? And you're buying calls and puts on both sides. So with the iron condor, you can look it up if you're interested. What I want you to understand about it, again, this doesn't mean that you're going to make money. It doesn't mean that you should do this. It does mean that it will become more like a job. Like you will have to actually do the work for this. And I'm going to give you an analogy in a second here. But essentially, when you're doing more complex options trading, it's not just singular dimension. It's not just the stock goes up, you make money. It's more like, when you have these complex, like say an iron condor, right? What ends up happening is that as long as the S&P 500, let's say if you did an iron condor on the S&P 500, as long as it stays within this range, as long as it doesn't go up too high or it doesn't go down too far, then you make money because you're writing the options on that case. And you're writing some options, and then you're buying some options to protect your ass, right? So that you don't lose everything. It makes it covered, right? And anytime you write options, they have to be covered either by stock that you own or some other options that back it up, so that if whatever option you wrote, if it went wild, that you would have another option that you own where you could get the stock and sell it at that price, so that there's a limit to what your loss would be. If you wrote uncovered, what they call uncovered calls or puts, you'd be at a serious risk, right? You could make a whole bunch of money, but if the market moves the wrong direction on you, you could be really leveraged to the hilt and really lose money that you don't have. Again, don't have the time to go into all of this, but you can research this stuff if you want. I just want to tell you so you understand what happens here and how this works. And so anyway, so an iron condor, when I used to trade iron condors, there's a strategy for it, okay? And like I said, there's a whole book on it and that I read that was interesting. There's tons of books on this. But with that strategy, what I would do is I would buy the right options and sell the correct options over time with the right dates in order to create this condor. And there's trading platforms where it'll show you kind of the shape of the thing, and then you're predicting that, like, you've got, maybe depending on how you do this, maybe you have an 80% chance that, let's say we'll use the S&P 500, the ETF for the S&P 500, 80% chance that it's going to stay within that window, okay? And in that case, let's say you're going to make $2,000, okay? But there's like a 20% chance that it's going to clip outside, and then you're going to lose everything, so you're going to lose $10,000, right? And that's usually about what the ratio is with iron condors, right? Is that you're either going to make $2,000, but you're going to make it like 80% of the time, or you're going to lose 10,000 20% of the time if you don't do anything. So you can adjust the condor, right? As the market's changing and you look at the deltas and you look at how things are going, you can actually adjust one end of the condor or the other end. Lots of different strategies for do that, or you can roll it forward. There's a lot of different, that's where things get complicated. And so, I spent definitely some years studying this stuff, trading, and what it came down to was that it's a full-time job. And I will compare it to something that's very similar that I also got involved with, which was poker, okay? When I played online poker, and I played poker semi-professionally, I was making money, I was doing this, quite a bit. It's the same strategy, okay? It's the same idea of what it's the emotion is that what you have to master. That's how you become good at these things. It's like, in order to play poker profitably, there's a set rule, like you can learn the game and you can learn the rules and you can learn what you should do in different situations and how to manage your bankroll and how much money to put on the table and what your probability and odds are and what your variance is, right? And what is an expected value positive situation and what's an EV negative situation. And you can know all this stuff, but then you got to do it. You got to execute it properly. And when you get pissed off and you go, quote, on tilt, or you're eager and you just want to make more money, or you're greedy, and right, so you don't pay attention to the proper bankroll management, you don't pay attention to the odds and the variance, right? All these things can beat up on you and take an emotional toll on you, and you have to really master your emotions to do this. The same thing with complex option trading, right? When I was doing it, I was making returns easily of a few percent per month, right? 4 or 5% per month, pretty easily with very, very little risk because I was following the rules and I was, right? And so your yearly returns, if you're really good at option trader and you were really playing it, sitting there all day, like adjusting your options, doing it to the best as you possibly could with these complex options, you could very conceivably make 15 to 20% returns per year, maybe even more. I mean, I've heard of some guys easily like making 30% returns consistently. Okay, so you can do this. It's definitely possible. I know some people are going to call bullshit on me, but trust me, if you can't, if you can't talk about complex options, you've never traded them, and you don't understand this, then I can understand you being skeptical of it. But I'll tell you, the trade-off here is that it's like a full-time job. When you're managing complex options, not only are you doing a lot of work and following the market and studying and watching what's happening and adjusting it and following these rules, okay? And you've got multiple trades and you can't put too much on any trade, right? You've got to adjust the things and you've got to have like a game plan of, well, if this happens, I'm adjusting the option this way, right? And you have to be able to execute all these things and do it, and you got to watch it, right? It's not just automated, some of these things. Okay, so not only do you have to have that, but you have to have the emotional control to be able to do that, because when you're playing with big money, right? It's really tempting to take the risk, right? If I have, let's say that, when I was trading iron condors, let's say I put $5,000 into a trade, okay? And if this trade executes correctly, right, I've got, let's say, $5,000 at risk. But let's say that if it goes all correctly, then my $5,000 that I have at risk, I'll get $20,000. Let's say that that's the case. Well, the rules, right, according to my own game plan, if it says that, okay, if this S&P, I'm going to use S&P 500, if it hits this point, if it goes up to like whatever it was, 1,400 or so, then I need to close out this end of the iron condor and sell this and take a loss of like $2,000 and I'm done. Right? If it goes there, I'm going to be emotional. I'm like, I don't want to lose $2,000 because I want to make $20,000. So maybe I'll just let it ride. I'm sure it'll go back down, right? And then I end up losing the whole $5,000, right? Or I take that risk. So again, I know that this is a complex topic, okay? But I'm trying to help you to understand in like, what is this, like 20 minutes, how this very, very complex world works as far as the option trading. But essentially, it just comes down to this, is that yes, you can make money doing this kind of stuff. Do I recommend it? Start a business, okay? Go and start a business online. That's a better thing to do. Produce something. If you're really, really interested in this stuff, it is fun, right? I had a lot of fun doing it, but you got to read. You got to learn all this stuff, right? You're not doing singular dimensional options trading and making money. That's just betting. It's just betting with leverage. That's all it is. But when you do multidimensional stuff, you can literally construct a financial instrument that will work under whatever circumstances that you want. And you can even combine option trading. I used to combine it by hedging my bets with futures. So I would buy futures that are correlated directly to the specific options, and that would hedge the bet so that if one thing went wrong, the other thing saves it. There's a lot of ways to set this up to make it so that you can literally limit your losses. And I'm not just talking about stop losses. I'm talking about you can really create predictable results within something as wild as the stock market, because it doesn't matter, because you're changing it, right? The people who play the stock market and lose are people who are betting on the stock market. They are gambling, okay? They are basically betting that the stock will go up or the stock will go down. They're predicting, okay? But people who make money trading complex options, they're more like I said, the poker players, they're more like it doesn't matter what the market does. What their ability is to adapt to the market and to create the financial instruments that whatever the market conditions are, that they will be able to make money, a small profitable amount. It's just that the temptation is there of taking the larger risks. The temptation is there of backing out of, it's the fear and greed. And so they require discipline. They have to have the know-how, and they have to work and they have to watch this stuff. So you're getting paid for a job, right? It's a good job and you can make a lot of money, but it's a very, very high stressful one. You can really fuck up and you can lose it all, right? There's definitely some negatives to this, and you have to have the knowledge to be able to do this. This is not just, understanding puts and calls. Most people don't even understand that. Again, this is why in my book, in Soft Skills, I explained a lot of this is because most people don't even understand what options are, okay? But that's still the elementary level. That's still, there's still a lot more to understand. Straddles, covered calls, all of these things in complex ways that you can do different spreads across date, across different strike prices. There's a lot to it for sure. So it doesn't mean that you can't do it. Like I said, you don't have to be a super mathematician. You don't have to be a rocket scientist, but you have to understand that there's a lot of complexity to it. And mostly when you're good, when you have the understanding and knowledge of this, what it comes down to is a contest of your self-discipline. Can you actually exhibit the emotional control to be able to do this, to deal with the wild swings and the variance? It's very, very much like poker. Anyone who's played poker professionally and traded options professionally will equate the two and say, yes, they're exactly the same skill set, exactly the same. So, and I've done both of them, and in fact, that's what drew me. Maybe this mindset is what draws me to all of these type of things, including fitness, where you know what to do, but you got to just fucking do it. That's the hard part of a lot of this stuff. So, all right, that's a really, really long answer, but I hope that, if you have any more questions about some of the stuff that I said, first of all, read that book that I gave you, but then leave a comment below or email me at john@simpleprogrammer.com. I'll try to explain some of this stuff. I should create like a financial channel separately, but this is fun. It's interesting stuff, and I hope I cleared this up. I hope this makes a little bit more sense. And I know some of you are still skeptic. Read. All I can say is read. If you read and understand it, I'm not going to say try it out, because it might not be worth trying out, but at least read and try to understand this stuff, and you'll see what I'm saying. Trust me here. All right. That's all I got for you today. Click that subscribe button if you haven't already. I'll talk to you next time. Take care.